world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. The investment space is changing as fast as any other financial services vertical. With roboadvisors, free stock trading apps, contextual behavioral experiences, software automation, AI, new pricing structures, and crypto, all shaping the future direction of the industry. Today, we discuss the current state and likely future of the space with two of the leading firms in the industry. Chris Worle is the Chief Digital Officer at Hargreaves Lansdown, the UK's leading retail investments platform. Joe Parkin leads the UK iShares business and digital wealth for Northern Europe at BlackRock, one of the world's biggest investment firms. This conversation is a great complement to past episodes with Nutmeg, Betterment and Scalable Capital, exploring the evolution of investment management. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Chris Worle and Joe Parkin. Joe Parkin and Chris Worle, welcome to Rebank.
Thank you.
Thank you.
Thank you for having us.
My pleasure. I've been looking forward to this conversation for a while. I think a lot about where the investment space is going. Maybe just to kick off, intros from you guys, if you could describe specifically what it is you do in the day-to-day to help set the scene for the perspective you bring to this digital-focused conversation.
Yeah, sure. So my name is Joe Parkin. I am responsible for the iShares business in the UK, which is our indexing, so ETF and index fund business, and any solutions we derive off the back of that, as well as responsible for digital wealth across Northern Europe. And that is very much helping our clients evolve their investment and technology needs to help meet the challenges they're facing in the modern world. And so we think the world is going through an era of digitalization, and what can be digitalized over the next 3 to 5 years will be digitalized, and we want to make sure we're helping our clients along those journeys.
So when you say digital wealth in Northern Europe, what form does that take?
So BlackRock is obviously well known as one of the largest investment managers in the world, and we're a provider of technology, so technology solutions to the industry, and digital wealth is very much focusing on the wealth side of that. So how can BlackRock help our clients evolve their digital propositions? How can we provide bits of technology in order to do that? Great.
Chris?
I'm Chief Digital Officer at HL, title I've held now for coming up to a year, and really that's about focusing HL on the long term, the longer term opportunity, the longer term challenges it's going to face, whether that be disruption through regulation, technology, shift in consumer behaviours, or whatever else is lurking around the corner. And really now we're a business which we've been going 35 years, so we've got a bit of legacy and a few technology challenges there. So it's really about focusing how we inject pace back into the business, how we continue to deliver an exceptional experience and service for our clients, which has always been at the heart of what we do, and how we continue to deliver the growth. We've been extremely successful, particularly over the last 10 to 15 years. We see huge opportunity within the UK to really help people save and invest for their futures. There's a huge need out there, and we ultimately want to be the ones that help people with those needs.
No, well, I think Hargreaves Lansdown is such an interesting case study in this transformation. So that what you said, what a 35-year history, but I think of Hargreaves Lansdown kind of coming into its own during the shift to online. So basically being the online first self-directed investment platform in the UK, and it's now a massively valuable listed company. And now, interestingly, just what I guess, as you were saying, 10, 15 years on from really kind of taking the market by storm, it's, well, wait a second, now we're no longer the quote unquote digital challenger. We're looking at a slightly dated, compared to say a free trade who's in the midst of building their platform now, stack, massive customer base. What do we do?
Yeah.
What sorts of conversations are you guys having at the moment? How are you thinking about that?
I think that's one of the interesting things over the last couple of years. People started referring to us as the sort of kind of incumbent and that, and I think we still internally absolutely see ourselves as a challenger. As I said, there's a huge opportunity, huge market within the UK that still needs serving. So I think the proposition that we've developed over the last 10, 15 years, looking back, it felt like the easy things, like allowing people to view their pension online, was revolutionary back then, when it was just sort of a piece of paper that people used to get once, twice a year if they were lucky. The fact that now you can view your pension when you're on the bus or train in the morning on your mobile phone is, again, amazing, but has just become a default expectation now. So the pressures to deliver, the pressures to keep improving that client experience and delivering those tools and features has never been greater.
And I think we've got so far to go, right? There's been a significant shift in responsibility in very recent times, from the state and the corporate onto the individual with regards to their retirement or regards to their savings. And I think this is an individual that kind of is struggling to adapt to that responsibility. I think some people have done. And some people have found, whether it's a DIY investment platform, whether it's a robo-advisor, if they're fortunate enough to have a wealth manager. But there's a huge swathe of people in this country that just don't have access, or don't have the education, or just don't understand that they actually need to be doing something right now in order that one day they can actually end up retiring, with a decent amount to live on.
Yeah. That's an important point that kind of overlays this entire conversation from a UK perspective. This I think what you're referring to is the shift from the defined benefit to the defined contribution pension model, which happened now, some decades ago, or decade plus. But I think that last time I looked, balances were still something like 75% defined benefit, 25% defined contribution in terms of pension balances sitting out there, because people that went to work in the 1970s on defined benefit programs have accumulated that, and kind of that skew of balances is still sitting in the defined benefits piece. So there's this transition flowing through where people are responsible for more of their own savings and making their own investment decisions. I think, Chris, correct me if I'm wrong, but the Hargreaves Lansdown kind of rise to prominence coincided with that shift toward defined contribution, which presumably fueled some of the AUM that you guys have on the platform.
Absolutely, that momentum's helped. I think we were also the ones who cottoned on to the fact that it was more than just a sale. It was about relationship building. It was about providing the information, the tools, the content to really help people make their own decisions, empower them, give them confidence to make those decisions themselves. I often say we were doing content marketing before content marketing was a thing. But that relationship building has been a hugely important part of what we do. But I think, going back to your point, Joe, I think certainly the other area that I don't think UK industry switched onto yet are those opportunities and challenges in retirement itself. Like the pension freedom changes, and was it a few years back, it's completely changed the game for how people will manage their money when they're in retirement, and the needs they'll have through retirement, and the help and support they'll need throughout retirement. So there's a lot of focus on the millennial chasing in the millennial market for fintech and financial services, but there's huge needs coming that will come through over the next decade or two for those people actually in and approaching retirement that you don't quite see people responding to yet.
Yeah. Well, you talked, Chris, about how the relationship was the kind of driver behind Hargreaves Lansdown's philosophy and that kind of education empowerment of customer. And yeah, fine, okay, so we're switching from a browser to an app and maybe to whatever else comes next. But it doesn't fundamentally sound like that core part of your ethos needs to change. So the question here is, I guess that we can pick up throughout the course of the conversation is to what extent have digital offerings that have hit the market solved for that kind of core emotional, behavioral, psychological piece versus click here to trade, which may or may not be really capturing the power of the technology we have at hand.
And I think that'll be interesting in the fintech space, who manages to cross that bridge in terms of, I think, in the banking and the wealth tech space, you've seen a lot of people create a brand quite quickly. And I think particularly in the banking space, you've seen people engage with those brands, but you haven't quite seen the volume of people fully trust those brands and fully go all in terms of, I'm going to trust my entire current account or savings with you guys. So I think there's going to need to be more than just creating a sort of hyped, flashy brand, dare I say it. And actually it'll be the key of whether actually people can build that relationship and build that trust to really get people engaged with those services and brands.
I think what we're really struggling with, and I think banking has kind of got that over the last year or so, is this engagement and making it relevant to people's lives. Because, two things. Firstly, no one ever wakes up in the morning and goes, I must be an investor or I must educate myself around investing. Education, unless it's mandatory, actually has to be the person's decision to actually go and do it. The second thing is there's always a tomorrow in investing in retirement. It's such a long-term goal. It's not like I'm putting something away for a holiday this year or next year. It is 30, 40 years down the line. I think that's really hard to get people to really properly engage with it. So I think we have to really focus on the engagement. I think there's a number of different ways to do it. I really like the idea of making it seamless. I think we've seen huge success from the likes of Roundup technology, which kind of create investors out of people before they've even realised they've become investors, and suddenly they have £1,000 sitting in an investment account. I think the second thing we have to do is make actually people connect with what they're actually investing in. So I think there's an enormous opportunity with regards to ESG and making that really connect with the end consumer who does care about the number of plastic bags they're using, the number of that. But I tell you, it's a far more effective way to do it within your pension or with your investments in terms of choose companies that are doing good things in that space rather than potentially like not using plastic bags. So I think we need to change the psyche there. But I think just making it more engaging and more relevant, that's what we're really missing in this industry. Because as I said, I think the rest of them, the technology, the responsibility that I think people are starting to get, we have. It's just how do we make it more engaging?
Because succeeding in investments is basically the opposite of YOLO. So how do you reconcile the digital world, constantly engaged, always on, instant gratification, with the end results of successful long-term planning?
I think we've seen this in roundups, right? Which is at one stage it was give up your coffee. And put it into a savings account or an investment account. Now it's have your coffee and we're going to round you up into a savings and investment account. So I think that's one thing. So I think that's why I'm a big fan of roundups and how I think it can engage people without really or get them into doing something without making them feel good about it. The second thing which we're starting to see is this stuff around affinity brands and the idea that we're going to take a taxi, and as part of that taxi journey you're going to put 50 cents or 50p or 50 into a savings account, or it might be buy some trainers, or it might be go out to a restaurant and that sort of stuff.
And would it be the taxi app that offers that automated savings piece?
Those affinity brands, in order to make sure that, like, you know, like I think some of these brands now have, these financial services brands they've got millions of people. And there is followership of them, you know, and people are thinking about it the whole time. So, you know, if you own someone's financial wallet, so I think it'd actually be good. It's kind of the brand kind of paying for you to use it, but you're actually doing something good off the back of it. So I think that's super important. The other thing I also think about engagement is we now have a lot of data. And we have an understanding of what people are actually doing on a day-to-day basis. I think open banking is going to be massively helpful for this. But suddenly, like, you can start to reward people, or start to provide them with, like, that ability to, you know, an affinity situation, you know, for doing good behaviour and reaching their goals and that sort of stuff. And I think that's also going to be super important to get people engaged, because I think people get it a little bit, like, people often say, okay, you shouldn't be logging in to look at your investments every day. And I completely agree with that. Like, you shouldn't be touching your investments every day. But what you should be doing is thinking about your long-term financial well-being every day. And every day you should be nudging yourself that little bit closer to being financially independent with regards to retirement.
Mm-hmm. I was talking with it was on the podcast, so long time listeners, regular listeners may have caught it, but Ryan King, the co-founder of Chime, which is a very successful digital bank in the U.S., was talking about his preference for automation over nudge. So I think I at the time, I'm not sure it had landed with me at the time. I think I was more of the school of thought that finding the right kind of behavioral hook would really solve this issue around customer engagement and saving, around customer engagement and longer term investments. And he was much more of the view that forget all that, you're much better off just setting up some sort of automated savings piece. You know, every time your salary hits your account, 10% goes into savings. You never even see it. You don't really check your in investment portfolio all that often. All you know is you wake up one day and you're 65 and you've got a nice nest egg there. I think he's probably got it right to a large extent around investments. I mean, if you think about the difference between, you know, instant gratification of buying and selling a stock, or, you know, signing up for a new robo versus, say, the auto enrollment laws that came into effect here in the UK last year, the year before, which kind of forces each employee to save up, I think it's something like a percent, some sort of minimum amount, unless they actively opt out. I think that automation at scale is a powerful tool.
I agree with you. I don't think we can fit one. You know, you just mentioned 10% of the. So I think a couple of things. Firstly, engaging people early. And that engagement early might mean that, you know, the vast majority of money you're trying to put away, maybe paying off debt, and making yourself in a cash buffer. The second thing is, I think, you know, I don't mean to, but we're trying to solve for a problem here with millions of people that, you know, actually are living paycheck to paycheck, which I think is a really important thing to recognise. And so, you know, 10% of their salary may not be possible. So I think we have to start small. I think also, like, and I agree, we have to do it for them. I don't think we should necessarily automate it. We have to do it for them. And then I think we have to nudge them in the right direction when we possibly can, to potentially get to that panacea where you are literally parking 10% of your paycheck at a really early age into savings and investments, so that one day, you know, you end up with a nice nest egg that you can actually retire.
You said it right. That early engagement's really important. I think we need to be doing much more from early ages in school to educate and inform. I think on the auto enrollment piece, I think, again, at mass, at scale, I think it's absolutely critical to ensure that we are catering for everyone, and it's a very important tool. But I don't think that can be done as an excuse or a get out of trying to get people engaged and thinking about and taking responsibility of their finances themselves. So I still think there is huge amounts more to do in that area.
I'm going to shift gears slightly. I'm super interested to get your guys' views. So UBS, I think it was sometime last year, shut down, I think it was called Smart Wealth, some sort of effectively robo offering, lower minimums. And Investec recently, just maybe a couple weeks ago at the time of recording, closed its Click and Invest offering, similar robo-type play for lower minimum AUM amount. And I appreciate that you guys probably can't comment on specific companies, but in terms of the relevance and or viability of a robo-advisory type model, based on what you guys have seen and the types of people that you're interacting with, where do you see robo-advice fitting into the broader digital wealth spectrum?
I think it's been interesting to see the shift that's been happening over the past few months. So my view is that I think there was a lot of hype around robo advice, and I think again you've seen a lot of businesses focus on the technology and the process of it, and that's been a very technology stroke business led initiative. And I think where some propositions haven't really sort of delivered, I think, is because they haven't focused on the needs and the problems that they're solving for the end user. I think some of them are really sort of kind of they're assuming that someone sits down one day and goes, I'm going to sort out all my finances and think them through and sit in front of a computer for however long and plan it through that way. I think people's thought processes, people's journeys happen much more iteratively than that. So I think there's a case to really understand what the consumer demand and need is, and I think there are some out there doing it very well. And I think as we discussed just now, it's focus on making it easy, accessible, and solving one problem at a time. And I think that's how you get people engaged and starting on that journey around thinking their investments, engaging with robo advice. I think the other point I'd also make is I don't think you can underestimate the importance of that human contact still as well. So I don't think you can deliver just a purely digital solution. This is people's life savings and wealth and future prosperity. And actually, quite often, what we see is people do just want to put in that phone call and check that there's someone there on the end of the phone. They may have a couple of specific questions, they may not, but they just want that reassurance. And again, it comes back to that trust and confidence point that someone is going to be there to answer their questions or their needs as and when they might crop up over the years ahead. So I think that tailored solution.
But that might not be specifically advice, right?
No.
It might just be, have I filled this in properly, or I need some comfort here.
Yeah, it's exactly that. It's yes, Mr. Jones, you're not doing anything stupid, or yes, you have understood that right. It's just that reassurance point that you can't really get from going through a purely digital process.
So I'm completely on board with this in terms of the role of the human and the role of the machine. So I think if you think about the UK population, so I think last year 3% of the UK population received advice. I think 9% have ever received advice. So that leaves 47 million people in the UK with no access to advice. I think the role that the advisor plays is absolutely critical. And whenever you look at any of the data around do people value their advisors, it's a resounding yes. They provide incredibly valuable service in. We've got two options. Either we go and find hundreds of thousands more advisors to help the UK population and do something that is probably not cost effective given their time and what they need to go through, or we find technology that kind of helps them scale. And I think this is what robo-advice is actually really trying to do. I think there are some parts of advice which is really hard to scale. So I think retirement is a really hard thing to digitalise and to scale at this point in time. I don't think we have enough information generally about the customer, especially, or we can acquire enough information before someone gets bored and drops out of a digital journey. So I think we have to scale advisors. We have to use advisors and their time when it's most needed. And so I think that's a combination of technology in the robo advice market, as well as making sure we have people that actually just provide guidance and just provide like a little bit of coaching to say, yes, you have done it right, or no, you haven't, rather than putting advisors on the phone at all points in time, because advisors are a really precious commodity. In terms of like what we've seen, I think there have been some lessons learned from what we've seen over the last few years with regards to people that have come to market. So advice not being binary. Advice, when you open your first ISA and you put £20,000 to work in your first ISA, like, should you go through? Like, if you've got an intent to do that, do you need a long journey, asking you a load of questions where you don't have the information to? That's a question mark. So can we do that easily and quickly? I think we often try and do too much and sort of boil the ocean too quickly. Let's engage customers and then build out, so let's engage them on on their ISA and then help them with their pension at the right time.
But how much of that is regulation driven? You have to do the full 2-hour in-person interview deep dive thing.
Yeah, and I think that's an area where regulation, I think, could really help here. Is I think it's the advice gap. There's too much of a difference between sort of that non-advised, and then as soon as you sort of step into the advice territory, you become sort of all of these other commitments and requirements flow in. Actually, to Joe's point, that we've got to stop thinking about clients as sort of kind of advisory or non-advisory. There is a continuum in between, and allowing people to easily migrate between the two and sort of move up towards or back from one solution, I think would really help.
So does that mean the regulators need to fix the problem, or that firms somehow need to design different journeys that they could within the scope of regulation, they just haven't?
I think the challenge is on both. I think there's absolutely more that industry could be doing, and I suspect people are already doing. So I think it'd be interesting to see what comes through, and I think it comes back to, again, focusing on the consumer needs, and I think one of the things that we've seen, and we don't believe that a lot of people need advice throughout their entire lifetime and don't need to be a fully advised client throughout, but you see people go through their life stages and certain life events. Retirement's obviously a big one, where they do need that advice check-in, they do need that help. Some people still don't need that full advice service, but they do want someone to be able to ultimately sort of give some point advice answers and help on things. And I think that's where regulation could sort of adapt a bit, because that's what clients want. People want someone that they can speak to who go, actually, I don't want to go through this full process. I actually just want you to answer these specific questions for me. So I think a way in which we could do that would really help.
We've seen a wholesale shift away from active management toward passive. Is that permanent? Is there ever going to be a return of, say, active management kind of retrenched? They've solved their kind of cost issues, and instead of charging ridiculous fees and kind of feasting off of retail investors, they come back with a more kind of technology enabled, but still in some sense alpha generating piece, and ETFs
I just think the whole
argument,
anymore. The whole comment, the thing around active and passive is just nonsensical. And it's not, and no one understands it outside of the buildings that exist within these industries. So actually, let's move on. I think every single decision that happens within a portfolio is active, and I think in terms of whether you're going to use alpha generation managers or people that are managing money to a benchmark, I think we're going to continue to see a blend of both in the portfolio. I think both of them have looked at their pricing and worked out where their value is over the last few years, and I think that will continue to happen. But I think both of them will be continued to use in portfolios. But I just think it's just a active and passive. It's just I don't think it makes sense.
But isn't the all-in cost of investment management for the average client in the UK something like 2.5% per year, and that's not because they're in auto rebalancing ETF portfolios. It's because of fat fees and margins that are kind of still ticking away, right? I mean, doesn't that play into the active versus passive conversation?
No, I don't think it does. I think it plays into what people are willing to pay for the service. And I think, all-in cost includes a number of things, not just the investment product. And so I think as long as people are transparent about it and the customers see value in what they're getting and how they're getting it, which I think we've done a huge amount of, by the way, in the UK, and really led the European investment industry, then I think people will continue to pay for value.
And I think exactly to that point, I think there is too much focus on pure price play, and I think it does come back to that value question in terms of all in what the client is getting, the service experience and support and help that they do get every step along the way, and the value that they place on that.
That maybe I would be hard pressed to believe that someone paying 2.5% a year for investment management genuinely feels they're getting value for money. If you just kind of stretch that over the course of however many decades they're likely to be with that firm, you're talking about massive reduction in their long-term financial well-being.
Absolutely, and I think the transparency's got to come in there so that clients are clear on what they're paying for at every point. Because again, I think particularly advised clients who are paying hefty annual fees. Again, going back to my point earlier, do people need to be paying that hefty cost of advice year in, year out, or is it just do they need that service where they check in at the relevant point?
Do firms have an obligation to the extent possible, look to upgrade and improve their pricing with the arrival of technology solutions, digital solutions that allow them to create efficiencies and lower costs on the back end?
Well, I think the industry's done a great job around transparency, and I think it's very transparent to clients now how much they're paying, all in. And I think it's up to them. The industry has to provide clients with choice. They have to provide clients with different levels of service and different levels of human versus machine sort of interaction. And I think as long as we're providing that transparency, then the customer can make their own decision around whether they actually pay for that or not. And so the huge amount that's been done around transparency, I massively welcome, because it does allow the consumer to make their own decisions around what they're doing and what they're receiving.
And I think it's easy to forget what choice people do have now, sort of from the platform space. Then yes, you do have sort of low end providers, you do have more expensive providers, and again, if for whatever reason you do value that full advice experience and want to pay for that relationship, then you've got plenty of choice and price range out there too. I think that the transparency point is absolutely right. It's there. There's more transparency now than there ever has been, and I think people are paying closer attention to that than they ever have done.
On one side of the market, which I suppose represents kind of the lion's share, if you look at total AUM, there's what would, I suppose it'd be hard to call it anything other than kind of a price war going on. The Fidelities and Vanguards and Schwabs of the world, massively lowering the price of a lot of their services. Do those organizations that don't want to comment on specific companies, appreciate there's some sensitivities around that, but do the largest incumbent organizations have cost advantages, business model advantages that will result in them accumulating more and more AUM going forward and potentially kind of squeezing out smaller, medium-sized players? Is there a future for a smaller or medium-sized asset manager?
I'd hope so, because I think some of them are delivering some really exciting and interesting propositions, and I think some of them are doing well to build scale. Some of them are really solving some of the consumer challenges and engagement challenges out there. So whether they will succeed in their independent form, or whether they succeed through being swallowed up by larger entities. You can argue whether that's a good or a bad thing, but I think some of them do seem to be scaling. I think they do have, the newer startups do have that advantage quite often of being more agile, and quite often, okay, yes, they don't have the economies of scale, but actually they have that lighter, faster technology from which they can develop. So I think it's ensuring that they continue to leverage that, and I think they should be able to do that as a result, because I think a lot of the other more incumbent businesses now are tied up in legacy and slower to maneuver. So I think if they spot those client opportunities, if they spot the consumer demand and follow that, then I think they should be very successful.
I mean, I think there's a huge amount to go around. We could do with a lot more choice in the industry, and you know, as I said earlier, there's a huge amount of people that just don't have access right now, and you know, there'll be firms that pop up that cater to all sorts of tribes or area of society. And I think that's a super positive thing. So I think there's a huge amount of room for, you know, and you're so right. Like it's about agile, it's about tech agility, and you know, at the moment things are moving so quickly that it's a real battle for the incumbents or for the large organisations. They have a lot going for them. Their tech agility really is their blind spot, being able to move a big tanker. And so I still think there'll be opportunities for a lot of fintechs or a lot of startup firms to come in, find an area of the market they can quickly go after going forward.
Yeah, and I think there's still plenty of gaps to go for, and I think you're absolutely right. So many of the fintechs have brought huge variety to the industry, which for years actually was just trying to score points off each other and just replicate each other and try and be the biggest. And I quite often in conversations do refer to Nutmeg, because everyone expects me to be sort of negative about them, but actually I think they were the first ones for so long who actually brought something genuinely different to the industry, and tried to mix it up and shake it up a bit, and we've seen others follow, and I think that can only be a good thing.
I mean, there's still areas around children and interconnectivity around intergenerational wealth, women. I don't think the industry does a particularly good job at talking to women. Millennials, people are actually starting to talk to them, but like it wasn't that long ago that anytime you mentioned like you should talk to millennials about investing, everyone will tell you they don't have the money and they're going to buy a house, so they're not worth talking about. There are companies out there now who are sweeping up huge swathes of millennials who have found they actually invest, they actually care about their future, and they actually want to start to save for retirement because they realise that actually it's going to be all on them. So I think. Well,
you also need to realise how long that conversation's been going on. That conversation's been going on for about the last 10 years. So actually now, over those 10 years, those millennials have finally accumulated some money with which to invest. So the story does come good eventually.
What do you guys make of the subscription model, as opposed to percentage of AUM, flat fixed amount subscription?
Well, I think everyone understands it. That's the first thing, and I don't think many people understand basis points or percentages. So I think it's got a huge amount of validity there, and I think it's something that the industry will end up exploring, and there'll probably end up being two different models. There'll be a basis point model and there'll be a subscription model. I think when you look at other industries, which is, you know, and other industries that have really changed the way that people interact with that particular industry. So whether you look at the entertainment industry or whether you look at the music industry, subscription models have taken things by storm. And we've even started to see this, you know, with some of the firms in the US around Roundup Technology and that sort of stuff. So the likes of Acorns, where actually, you know, they charge a $1 a month. And so I think, and they've been very successful doing it. So I think there's a huge amount to explore there, because I think people get it, and it's a way to engage them. Because, like, yeah, I'm paying $1 a month, and I know what I'm getting, rather than I'm paying, you know, as you said, like.
I have to look at my performance report at the end of the year to figure out how much it costs me.
Yeah. And I think it's a really simple way to explain it.
Yeah, and I completely agree with Joe. I think there's a lot to explore in that area. I think from a pure sort of maths point of view, I think the dynamic that got to figure out is that sort of arguably a subscription model, sort of flat fee subscription model, benefits those with larger portfolios who aren't going to pay the big percentage fees, whereas actually I think the opportunity of the subscription model is to actually get more people engaged and into the industry.
I've heard someone suggest some sort of like capped percentage of AUM model, which also intuitively makes sense. More confusing than just percentage of AUM. So maybe not so good from that standpoint. But on the basis that it doesn't cost 10 times more for a massive investment firm to manage 10 million than it does 1 million or 100K, that intuitively makes some sense too.
But I think there's the opportunity for the fintechs and in the startups as well, is they're not wedded to this incumbent business model and revenue model. So actually I think, because the beauty of a subscription model is that it's simple and it's easy to understand. So I think as soon as you start creating a hybrid and tiers and everything else, it just defeats the point, because it gets complicated. So I do think that's where the opportunity again comes in for the startups, is they can build scale without worrying about sort of existing revenues.
Yeah. Joe, are you, in my understanding of BlackRock, you guys play in a few different spaces. It seems to me like there's something of an evolution in kind of the value chain or the supply chain almost of the investment management industry. If that's true, can you maybe talk about some of the evolutions, the developments that are going on?
We're very much a B2B firm. Our sort of mission or our mantra is help our clients build better financial futures for their clients. And so, the way we are set up is, to help our clients either from an investment perspective or a technology perspective, provide them with better solutions. And I think, what we're doing is very much, we spend a lot of time talking, listening to our clients to say, how can we help you? What are you needing to do? And so, when we look at the partnership we've done with Scalable Capital, that was very much a reaction to listening to our clients. And our clients were really telling us two things around technology. We need better technology to manage portfolios. There's been an institutionalization of the portfolio management process. We want to run portfolios at scale across the globe. And so we were very focused in developing technology internally in that space. The second one was help us get a better relationship with our end clients and help us provide a more scalable service. So it's either scale the advisor or help us provide digital wealth management to the millions of people we have. And so we've been very aligned behind that. Others have gone down different routes. Others have gone, other asset managers have gone straight to consumer. Other ones have looked at the platform world. But our mantra is very much how can we help our clients, which typically are institutions who deal with end clients, do that. So providing better solutions.
All right. So to wrap up, I want to ask us to get a bit creative. So if you guys were to design call it strip the brand away, you've got 10 million clients and something of a legacy stack, how would you be designing the institution for the next 20, 30 years?
So I think a combination of technology and humans, and dialing that up and down, not necessarily on how much money you have, but your need, I think would be super important. I think making sure that the technology was as agile as possible and it evolved quickly. And so I had really key technology partners, not software providers, kind of in order to do that. And I think also just engagement and getting people engaged. And I don't think that can be limited to a whole population. I think you've got to be very targeted at every single part of your sort of client base. So, designing journeys and designing engagement for this area versus that one versus another one. And so being multi-specific when that came to it. That sort of stuff. I'd also make sure that we didn't use the jargon that we currently use sometimes, and make it simple to understand, easy to use, and kind of understood that like in very similar way to the car and the engine of a car. I think often, the investment product ultimately is the engine of the car, right? It is the most important part of the car, and without it, the car goes nowhere. But do clients buy cars on the engine? No, they don't.
So would you? What about the product manufacturing or distribution piece? Would you go like the Tesla, like full stack, build everything yourself, or would you pick some well-designed, super cheap ETFs, roll them into your own portfolios, and help customers kind of self-select into
I think it's
them?
important to work out where your expertise are. And I think as an organization, if you've got 10 million customers, you must have some expertise. And so being very clear about where my expertise are, what I'm actually really good at, what I'm actually world-class at, and then being confident enough to potentially outsource or find partners to do the things that actually either I don't need to do, I'm not so good at, or actually someone can do it a lot better at. So if I'm probably 10 million customers, some of the stuff around technology, I can probably find people to come in and who can iterate quicker than I can. I can build stuff on the outside. So that would be the key for me, like working out what I'm best in the world at, keeping those things and then outsourcing.
Would you invest in an offering for people in their 20s and early 30s, or would you wait till they come back once they've made some money?
I just believe we should be helping people almost right from birth. Like I think the more we think about this as a whole of life conversation, I think so much the better. So firstly, that's through your parents. Then in school, that becomes a conversation with you around things like compounding. And what is an equity, what is a bond, all those sort of things. And I think it's about convincing people to get engaged in investing. So actually, we don't handle on into this retirement crisis. We actually get people to think about this earlier. It's like huge benefit of thinking about this in your 20s. So for me, I wouldn't, necessarily I wouldn't necessarily pick. I just think it's a whole of life conversation.
And I think that's one area where, again, I think there's still huge opportunity is again, we talk about a lot of the wealth sitting in the baby boomer era, and that's got to be passed down, and we still think about individuals very much within financial services, and starting to think about not only that family wealth but that multi-generational family wealth and the visibility and capability that we provide. And that's something that can really only be catered for in that sort of family office advisor environment at the moment. But actually how you help and enable people to start thinking about that themselves as well is an opportunity, I think.
Excellent. Chris, Worle, and Joe Parkin, thank you very much for joining us today.
Thank you.
Thank you, sir.
It's been a pleasure.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.